Cryptocurrency. It's the democratized currency of the future. But if you've recently made gains on crypto investment and want to cash out, how do you avoid or limit the amount of tax you have to pay? Welcome to Mindnificent. In today's video, we will take a look at 10 ways you can avoid paying crypto tax. One of the things that makes cryptocurrency so popular is the degree of anonymity you can transact in. That same anonymity drives financial institutions and tax departments crazy because it's one part of the economy they have little visibility over. Cryptocurrency tax regulation is still in its infancy, and much on-chain transactions lie in a gray area. Despite this, most countries at least require tax to be paid on income or capital gains from cryptocurrency. At this point, I do have to say that we are in no way advocating tax evasion or money laundering, and any advice in this video should be in context of your local laws and regulations. So, with that said, if you've made a decent gain on a cryptocurrency investment and want to trade back out into fiat, what are some of the ways we can avoid paying tax? Number 1. HODL. Your exchange or wallet balance may have a dollar amount next to it, but until you convert it into fiat currency and withdraw that money into your account, you technically haven't made or lost any money yet. For this reason, holding onto your cryptocurrency doesn't attract any tax, no matter what country you're from. If you do ever decide to sell, you can lower your tax obligation by making sure you've held that particular cryptocurrency for more than a year. If it has, your cryptocurrency sale may qualify for the lower long-term capital gains tax rates. This could save you a significant amount of money on your tax bill. Number 2. Spend your crypto. Even though it's still the early days of cryptocurrency adoption, there are still many outlets and online retailers that accept specific cryptocurrencies as payment for goods or services. While this process doesn't result in any physical fiat currency in your hand or account, it is an efficient way to put your coins to use without the watchful eye of the taxman. Number 3. Non-KYC exchanges. The majority of cryptocurrency exchanges are centralized and therefore require some kind of Know Your Customer or KYC process upon sign-up. Those exchanges are then required by law to report to your government's tax department all the deposits, exchanges, and withdrawals that occurred on their platform. If you want to keep your cryptocurrency transactions somewhat private, use a non-KYC exchange like Binance to purchase and move your coins. Number 4. Bitcoin ATMs. Another way to move your cryptocurrency is by withdrawing at a non-KYC Bitcoin ATM. They aren't available in every country, but where they are, they provide a safe and relatively untraceable way to access your crypto in funds. If Bitcoin isn't the cryptocurrency you are holding, swap your main coin into Bitcoin in a non-KYC or decentralized exchange. Recently, some non-KYC Bitcoin ATMs have come under regulatory scrutiny and have since had to enforce ID checks and strict authentication processes, killing the appeal altogether. Number 5. Offset crypto gains with losses. For those that live in a country with crypto capital gains tax laws, you can often offset the gains you've made against any losses you've incurred. When you sell any type of investment, you realize a gain or a loss. How much you realize depends on how much you sold the asset for and its cost basis. If you consciously offset capital gains against losses, this is a process called tax loss harvesting. Technically, gains and losses of the same type offset each other first. Short-term gains would offset short-term losses, and the same for long-term tax items. Then you can offset any resulting net loss against a net gain of the other type. In the US, if you have an overall capital loss for a year, you can claim up to $3,000 of it. Any leftover loss can be carried forward to future years. Number 6. Donate to charity. In most countries, donating to charity is a tax-deductible expense. There are limitations and qualification criteria, however. For instance, some tax regulations require the currency to be held for at least a year before being donated, and there are some upper limits on amounts that can be donated. Typically, you're able to deduct the current market value of the coin and no capital gains tax is paid on that transaction. Number 7. Give crypto gifts to family. Gifting cryptocurrency may help you avoid taxation on your gains. The recipient won't have to pay a gift tax either. Under current U.S. taxation rules, you can give up to $15,000 per person per year without filing a gift tax return or paying any gift taxes. Even if you exceed the $15,000 limit, you still won't have to pay gift taxes unless you've used up your entire $11.7 million lifetime estate exemption. If you're not a millionaire, I wouldn't worry too much about this one. The recipient of the cryptocurrency will need to know your basis in the cryptocurrency to determine the tax they owe when they eventually sell it. They will have to pay tax on the entire gain above your basis, but that tax may be less than if you paid it yourself. For instance, an adult in their 50s with a profitable career is likely to be in a higher tax bracket than a recent college graduate working their first job. So if you gift your crypto to a younger family member, the overall tax liability on that currency might end up being less. Number 8. Declare your crypto gains as income. Again, this method can depend on your local laws and regulations, but if you set up an entity, be it a trust or registered company, you can pay yourself as an employee. If you choose an amount below the tax-free threshold, you could potentially slowly withdraw your crypto profits and pay no tax on your income. If you wish to pay yourself more, your income is simply taxed at ordinary income tax rates, traditionally much lower than the rate of capital gains tax. Number 9. Buy crypto in an IRA. Traditional IRAs allow you to invest in standard investments, including stocks, mutual funds, or exchange-traded funds, ETFs. Self-directed IRAs allow you to invest in unique assets, such as cryptocurrency, precious metals, and real estate. By buying and transacting cryptocurrency through an IRA, you can avoid paying capital gains tax on the profits. While you'll be able to make tax-deductible contributions using traditional IRAs, you'll have to pay regular income taxes on withdrawals in retirement. With a Roth IRA, you have to contribute post-tax money to the account, but upon retirement, you can withdraw funds tax-free as long as you meet the requirements. Number 10. Move to another country. If all else fails, pack your bags and head to one of the many crypto havens that exist around the world. In El Salvador, Bitcoin is legal tender, and generous taxation laws means foreigners are exempt from paying taxes on crypto. It's been done as a bid to lure foreign investment, tech startups, and innovation into the previously struggling South American nation. In Belarus, mining and investing in cryptocurrencies are deemed personal investments and so exempt from income tax and capital gains until at least 2023. For German residents, any cryptocurrency held for over a year is tax exempt, regardless of the amount. In Hong Kong, if any digital assets are bought for long-term investment purposes, any profits are non-taxable under the profits tax. In Malta, it depends on the type of cryptocurrency you are holding. Bitcoin is seen as a unit of account, medium of exchange, or a store of value. Bitcoin income is taxed at the business income tax at the rate of 35%, while other cryptocurrencies and tokens are taxed at a personal income rate. In Portugal, proceeds from the sales of any cryptocurrencies are tax-free, as crypto trading is not seen as an investment income. It's the same in Singapore, Slovenia, and Switzerland, where capital gains either don't exist or they are exempt. Oh, and we can't forget Bermuda. While Bermuda is normally a tax haven for corporations and billionaires hiding cash, it's also a country that doesn't impose income, capital gains, withholding, or other taxes on digital assets or on transactions involving digital assets. And just to prove how crypto-friendly Bermuda truly is, you can even pay your tax obligation in cryptocurrency. That's all we have time for today. We must stress again that this video is not financial, legal, or tax advice, and that anything we say should be checked against your local country's laws and regulations. If you enjoyed today's video, please let me know by clicking that subscribe button and bell notification button, because more magnificent video is on the way. Thanks for watching, and I'll see you in the next video.